Right now, the most valuable real estate in the trillion-dollar commercial space race, well, it isn't on the moon,
Right.
and it isn't in low Earth orbit. It is actually sitting on a silicon wafer, about the size of your fingernail.
Mm.
So, welcome to the deep dive. Today, we are taking you far beyond the giant fiery rockets you see on the news, and we're going straight down into the hidden technological choke points that actually make the modern space economy and really the digital world function.
Yeah, it is a completely different way to view the infrastructure that's being built, right above our heads and in server farms right now.
Exactly. And to map this all out, we've pulled together a really fascinating stack of sources for you today. We are looking at social media sentiment analysis from Insider Monkey, some official corporate press releases from PR Newswire, and even real-time Web3 and crypto market insights from Certic Pulse.
But to ensure we ground all this internet hype in reality, we are actively contrasting those narratives against a very dense, highly analytical Q1 2026 financial report from Red Eye Research.
Right, because we need the hard numbers. Our mission for this deep dive is to connect the dots. We want to show you how massive, world-altering macro trends,
Yeah.
specifically the new commercial space race and the absolute explosion of AI data centers, how they actually converge on just a few really obscure micro-level supply chain companies. So, okay, let's unpack this. And I think we should start with the sheer scale of the space economy.
The scale is honestly what makes this so compelling. Morgan Stanley projects the global space economy is going to hit $1 trillion by 2040.
$1 trillion? That's just wild.
It is. But what our sources really emphasize is that the engine driving this massive growth, well, it's not government spending anymore. It is the democratization of space access.
Right, because launch costs have completely plummeted. We're talking a drop of roughly 90% in a single decade.
Exactly. And when you see a cost collapse of that magnitude, it completely rewrites the DNA of an industry.
Yes, space is no longer this monopoly held by NASA or, Cold War defense budgets. The floodgates have totally opened to private capital. And that capital is building real revenue-generating infrastructure up there today.
Which is precisely why we are seeing companies like BlackSky Technology stepping in. BlackSky is securing these massive, seven-figure contracts for their Gen 2 and Gen 3 satellite constellations. But the key here is they aren't merely launching hardware just to take pictures.
No, they're acting as a massive intelligence network. BlackSky is combining high-cadence rapid revisit imagery with AI-enabled analytics. So instead of just getting a static photo of a port or a military base once a day, you're getting real-time intelligence beamed down from low Earth orbit.
Right.
But BlackSky is essentially an end user in this scenario. To really understand the underlying supply chain, we have to look at the companies actually constructing that architecture. And that brings us to York Space Systems.
Yeah, York Space Systems is operating as what the aerospace industry calls a mission prime.
A mission prime. Okay, break that down for us.
So instead of just building one specific component, an emerging prime contractor like York, they aggressively seek to own and secure their entire supply chain. They have been on an absolute acquisition tear lately, making these highly strategic moves to absorb companies like Celestial and Allspace.
It reminds me of, if you really want to understand York's strategy, look at the 1849 gold rush.
Oh, that's a good comparison.
Right, because York Space Systems, they aren't out in the river panning for gold. They're systematically buying up the shovel factories, the pickaxe manufacturers, and the railroad lines. By acquiring these subcomponent companies, they're building a robust U.S.-based domestic supply chain.
Exactly. They want to completely eliminate their reliance on foreign materials for critical space infrastructure. And if we connect this to the bigger picture, York's aggressive consolidation is fundamentally about national security. Well, controlling the communication infrastructure in space means holding the geopolitical high ground. The sources point out that absorbing Allspace embeds York deeply into the U.S. defense ecosystem. They are supporting the U.S. Army and Navy directly.
Yeah.
But it also extends to European sovereignty, specifically the IRIS-2 satellite program. Protecting this critical communications architecture has become just a massive top priority for Western governments.
Okay, so if York Space Systems is buying up the shovel factories, like Allspace, we need to look at what those factories are actually producing, and even more importantly, who they rely on. Because Allspace doesn't make everything in-house, do they?
They absolutely don't. And following that supply chain down one more link reveals a really fascinating player. It's a Swedish company called Sivers Semiconductors.
Sivers Semiconductors.
Right. Allspace recently placed an $8.2 million production order with Sivers for volume production, which is slated to start in 2027.
Okay, the technical details of this order are crucial here. Allspace is buying multi-beam Ka-band beamforming integrated circuits, or BFICs.
Yeah.
And to understand why these specific chips matter so much, you have to look at the massive problem defense organizations are trying to solve right now.
Right. So historically, communication with a satellite was a strictly one-to-one relationship. You have a physical, motorized satellite dish on the ground, and it pointed at one single satellite in geostationary orbit.
Like the classic dish on the side of a house.
Exactly. But modern defense and commercial operators demand highly resilient, unbreakable connectivity. They need their tactical terminals to communicate across low Earth orbit, medium Earth orbit, and geostationary orbit. So that's LEO, MEO, and GEO all simultaneously.
Because if one satellite gets jammed or destroyed, you need the system to instantly connect to another one, right?
Precisely.
But you simply cannot physically spin a motorized satellite dish fast enough to track multiple targets that are zipping across low Earth orbit at thousands of miles an hour.
Yeah.
It's just physical impossible.
You can't. The mechanics fail.
Right. So you have to steer the signal using software and silicon, which is exactly where Sivers beamforming chips come into play. Instead of physically turning a dish, beamforming uses a flat array of tiny antennas.
Yeah.
And by delaying the electrical signal to some of those antennas by just a fraction of a millisecond, the overlapping radio waves combine and push the beam in one specific direction electronically. I like to think of it like dropping pebbles in a pond at slightly different times, so the resulting ripples combine into one large wave moving in the exact direction you want.
That is a perfect way to visualize it. Sivers is basically providing the silicon brains that allow all space terminals to perform that incredibly complex wave manipulation. And this specific dynamic is generating immense buzz on platforms like Certic Pulse.
Yeah, the crypto and Web3 crowds are all over this.
They really are. Retail investors and social media analysts are straight up calling Sivers a space and defense supply chain chokepoint.
Okay, wait, I have to push back on this sentiment just a little bit. If Sivers Semiconductors holds a massive critical choke point for the entire future of multi-orbit communication, why are we analyzing an $8.2 million contract? I mean, in the global tech industry, an $8.2 million order sounds like literal pocket change.
I know, it sounds small at first glance, but you have to understand the mechanics of the semiconductor hardware cycle. The hardest hurdle for any chip manufacturer is the design-in phase.
The design-in phase.
Right, getting your specific chip validated, tested, and physically engineered into a flagship piece of hardware like the Allspace Hydra terminal, that takes years of really close collaboration.
Because once you are designed into the actual hardware architecture, the switching costs become astronomically high.
Exactly the point. An aerospace company is not going to spend another 3 years and tens of millions of dollars re-engineering their entire tactical terminal to use a competitor's chip just to save a few pennies per unit.
Right, the risk of failure is just too high.
Exactly. Therefore, that $8.2 million is just the floor. It represents the initial volume production ramp-up for 2027. But it practically guarantees future volume and creates incredibly sticky, recurring hardware revenue as those all-space terminals are deployed globally for years to come.
Okay, I see. That totally explains why the Certic Pulse Insights describe this contract as a Trojan horse. It isn't really about the immediate cash. It's the fact that Sivers is now physically integrated into the larger defense supply chain of York Space Systems. They have effectively sneaked inside the fortress walls.
That is the core thesis driving the retail hype right now. They view Sivers as this bottleneck technology that the major players fundamentally cannot bypass to achieve their multi-orbit communication goals.
Well, if they have successfully embedded themselves into a monopoly position inside this fortress, you'd think they'd be printing money right now. But when we transition away from the social media buzz and open up that Q1 2026 financial report from Red Eye Research, we get a massive reality check. Sivers is actually bleeding cash.
Yeah, the financials present a stark contrast to their strategic momentum. Sivers' net sales for the first quarter of 2026 actually declined by 11%.
11%.
Yeah, dropping down to 61.9 million Swedish krona, and they are currently operating at a significant loss.
An 11% revenue decline while supposedly sitting on a space and defense gold mine. What is the disconnect there?
The red-eye analysts attribute the immediate weakness to broader macroeconomic gridlock. Specifically, there were delays in U.S. defense spending
Oh,
approvals.
Congress moving slowly.
Exactly. And that pushed significant revenue that Sivers expected to realize in the first half of 2026 all the way into the second half of the year. Furthermore, management is deliberately burning cash right now.
Why?
They're heavily expanding their global sales team to capture future demand, and they're also spending a lot of capital to build out the strict financial audit infrastructure that's required for a potential dual listing on a U.S. stock exchange.
Okay, so the narrative is that they're spending heavily now to build the foundation for future scaling. And to be fair to Sivers, the Red Eye report confirms that their future opportunity pipeline is exploding. It grew 77% year to date.
Yeah, that's a huge jump.
Sivers is now sitting on a pipeline of nearly $800 million, spread across 109 qualified opportunities.
A robust pipeline is certainly encouraging, but it brings us to the most crucial tension found within our sources, and that's the massive valuation disconnect.
Right.
The red-eye analysts employ very strict, fundamental discounted cash flow models. Based on the current cash burn and the delayed revenue, they set a base case intrinsic value for Sivers at just 6.2 Swedish krona per share.
Here's where it gets really interesting. 6.2 krona. Yet the stock is currently trading around 77 krona.
Yep.
It's like investors are paying Hall of Fame auction prices for a rookie's baseball card before he has even played his first major league game, simply because his practice stats look incredible.
That is exactly what's happening. And what's fascinating here is the brutal clash between traditional financial analysts and retail investor sentiment. Traditional models demand proven, predictable cash flows today. They heavily penalize the stock for that 11% revenue decline.
Sure, they look at the balance sheet and say, where's the money?
Right. But retail investors, fueled by those choke point narratives we saw in Insider Monkey, they are explicitly ignoring today's cash flow to bet entirely on the future.
Well, the Red Eye report actually breaks down the math of what that 77 krona premium demands in reality. To justify that price fundamentally, Sivers wouldn't just need to succeed, they would need to execute flawlessly for a decade. The market price implies a 35% compound annual growth rate, or CAGR, stretching from 2030 all the way to 2039.
And we really must emphasize how statistically rare that is for a hardware company.
Right, because making physical things is hard.
Exactly. Achieving a 35% CAGR in software is difficult, sure. But in software, your marginal cost of distributing a new copy of code is essentially zero. Sivers makes physical semiconductors. Scaling hardware at 35% a year for a decade requires navigating global supply chain disruptions, fab yields, securing rare earth materials, and surviving constant hardware iteration cycles.
Yeah, the logistics alone are a nightmare.
Right. Only a tiny fraction of hardware companies ever achieve that kind of sustained, flawless physical scaling. The market is pricing Sivers as if that perfect execution is already completely guaranteed.
It provides a truly fascinating dilemma for you as an observer. Do you side with the strict financial analyst demanding proven execution today? Or do you trust the forward-looking market sentiment betting that holding a critical choke point in the space supply chain is worth paying a massive premium for right now?
It is the ultimate test of an investment thesis. But just when you assume this is purely a story about space, defense, and orbital communications, the sources reveal a completely separate and arguably even larger catalyst driving that sky-high valuation.
Yes, this is where Sivers' positioning becomes absolutely wild. Sivers isn't just a wireless company making beamforming chips for satellites. They also operate a dedicated photonics division.
Right.
Imagine holding a winning lottery ticket for the new space race, and then you flip it over and realize it is also a winning ticket for the AI data center boom.
The artificial intelligence angle is absolutely critical to understanding that 77 krona share price. Sivers recently announced a major strategic collaboration with Jabil.
And for context, Jabil is a massive $30 billion global contract manufacturer.
You're right, they are huge. And they partnered with Sivers to produce 1.6T linear receive optics, or LRO, pluggable transceivers.
Okay, let's break down what a 1.6T LRO pluggable transceiver is, because it actually solves one of the biggest physical bottlenecks in artificial intelligence today.
Yeah, this is key.
Right now, billions of dollars are flowing into training massive AI models. To train those models, companies have to cluster tens of thousands of GPUs together inside sprawling data centers. But connecting those processors requires moving unimaginable amounts of data back and forth. Historically, we've used copper wire to move electrical signals between servers.
And copper has severe physical limitations when pushed to AI speeds. As you force more data through copper, electrical resistance increases dramatically.
Yeah, trying to run modern AI training models through copper wire is like trying to force a high-pressure fire hose of water through a plastic cocktail straw. The sheer friction generates so much heat that you literally risk melting the system. Data centers are currently drawing massive amounts of electricity just to cool the copper cables down.
It's incredibly inefficient.
So the physical solution to this bottleneck is photonics. You replace the cocktail straw with an open river of light. You move the data using lasers over fiber optic cables instead of pushing electrical signals over copper.
And this is precisely what Sivers manufactures. They create the indium phosphide lasers that power these pluggable transceivers. Furthermore, by utilizing linear receive optics, the transceivers physically strip out the heavy, power-hungry digital signal processors, or DSPs.
No, so they are removing the parts that generate the most heat.
Exactly. Because the optical signal isn't being aggressively retimed or amplified by those heavy processors, the energy consumption and the heat generated by the AI cluster drop dramatically.
So Sivers is essentially providing the laser technology that allows AI data centers to scale up without catching fire.
That's a great way to put it. And the Reddit report notes that collaborating with a giant like Jabil provided massive external validation for Sivers' specific laser architecture.
Right, because Jabil doesn't just partner with anybody.
No, they don't. And that partnership immediately triggered a wave of intense interest from other potential data center customers who are desperate to secure laser supply lines for their own AI infrastructure.
And their photonics reach actually extends even further than AI. Sivers is also preparing for an automotive LiDAR production ramp-up. They are securing their place in the supply chain for autonomous vehicles starting in the fourth quarter of 2026.
Right, so you have space, AI, and automotive LiDAR all stacking up.
When you zoom out and look at this entire deep dive, the fundamental challenge across these seemingly different industries is actually identical.
Oh, completely.
Whether you are bouncing encrypted data across a constellation of low Earth orbit satellites or blasting terabytes of data through fiber optics in a massive AI server farm, the underlying bottleneck is moving data quickly, efficiently, and without overheating the system. Sivers has engineered highly specific hardware components that solve that exact bottleneck in both domains.
It is brilliant strategic positioning. They are sitting exactly at the crossroads where two multi-trillion-dollar infrastructure builds converge. And that convergence helps explain why the broader market is willing to completely look past their short-term revenue delays and price the stock at such a massive premium.
Because they're buying into the vision.
Exactly. Those investors aren't just buying a quarterly earnings report from a semiconductor company. They are trying to buy an option on the foundational infrastructure of the future.
Let's quickly summarize the journey we took today. We started with the vast democratization of the space economy, right? We watched launch costs plummet while private capital and mission primes like York Space Systems rushed in to build and consolidate U.S. domestic supply chains.
And then we followed that supply chain all the way down to a seemingly small $8.2 million contract. And that revealed Sivers Semiconductors as a critical Trojan horse choke point for the future of multi-orbit communication.
We also confronted the harsh financial realities, exploring the massive disconnect between Sivers' currently delayed earnings and the market's expectation of a flawless, decade-long 35% growth rate.
Right.
And finally, we uncovered the hidden AI catalyst, seeing how Sivers' indium phosphide lasers are stripping out heat and power constraints to fuel the next generation of AI data centers.
It really serves as a profound example of how sweeping macroeconomic narratives eventually drill down to create massive demand for micro-level technological components.
So what does this all mean for you? Well, it means that understanding where the global economy is heading doesn't require a Wall Street degree. It simply requires a willingness to look past the finished product. Don't just look at the rocket launching or the AI chatbot interface. You have to follow the supply chain all the way down to the microchip level. That is where the hidden bottlenecks and the real opportunities are quietly being built.
And, it leaves us with one final lingering question to consider long after today's discussion ends.
What's that?
We are currently pouring trillions of dollars into building a new digital and extraterrestrial infrastructure, the orbital satellite networks, the sprawling AI data centers, the autonomous vehicles. But if this entire massive system ultimately relies on a handful of obscure, highly specialized semiconductor components, who really holds the power in the 21st century? Is it the famous giants launching the rockets and building the server farms? Or is it the unknown engineers designing the microscopic chips hidden inside them?
Wow, that is a thought that will keep you looking very differently at both the night sky and your computer screen. Thank you for joining us on this deep dive. Keep questioning the consensus, keep following the supply chains, and we will see you next time.